renewable energy stocks have sold off sharply in recent months and have been significantly underperforming fossil fuel companies, as clearly higher interest rates are taking a toll on this highly leveraged sector. To put things into perspective, the S&P Global Clean Energy Index, which is made up of the 100 of the biggest companies in solar, wind power, and other renewable-related businesses like hydrogen, has dropped 20.2% over just the past 2 months. That is in contrast to the oil and gas heavy S&P 500 Energy Index, which has added 6% in the same time. Not even including the effects of the war that is currently going on in the Middle East, oil prices going up has turned out to increase profits for the oil and gas heavy sector, despite what is happening with the financial markets and the tightening on a global level. Whereas what we all expected to grow rapidly in the form of revenue and profits in renewable energy, solar, wind, hydrogen, and electric vehicles are actually doing the exact opposite. However, folks, as grim as the outlook looks right now for some of these big clean energy names in a sector that has seen a lot of controversy, I am still largely optimistic about the investment opportunity that exists in this space. At the end of the day, climate change is one of the biggest challenges facing humanity. And although politics and the current administration might just be going ahead of the curve too fast and too quick, there is still a seismic shift we need in the energy ecosystem. And that is not going to happen without right investments, right technology, and right innovation. For those wondering why we are where we are, well, look at what happened 2 years ago when there was a huge growth in commitments to hitting the net zero target after the Paris Accord agreement in 2015. This growth resulted in a lot of investment opportunities, not only in the US, but in the EU and in China, which boosted the valuations of a lot of clean energy stocks and businesses. And that boost can clearly be seen by the performance of something like the ICLN from 2020 through to the start of 2021, when shares skyrocketed from around $7 all the way up to $34 in like 10 months. And although interest rates right now are expected to be near their peak, valuations are still plummeting back down to ground zero. And the reason for this is justified and is extremely simple. Renewable energy companies use a lot of financing and a lot of debt to grow their businesses. That is simply the name of the game when you are an unprofitable and a negative cash flow company. And right now, although personal investments are increasing, companies still need banks and traditional credit lenders to grow sustainably. It really is, all in all, an uphill climb for these companies, which is exactly why the reward potential for investors is also extremely high. The total addressable market for clean energy is estimated to grow to $50 trillion by the year 2050. And the aggressive net zero and carbon reduction targets that so many governments have set in place are really going to be pushing some of these companies to the absolute limit when it comes to revenue growth and profitability. And you see, folks, one of the reasons why now these valuations are starting to fall back down to earth and there is a sentiment of negativity around clean energy is because a lot of these companies that sell batteries, solar panels, and wind turbines often sign fixed price contracts and have locked in their electricity prices. And as the cost of electricity generation has gone up over the past 2 years with higher interest rates, the returns from these projects has really salted the mouths of most investors who would have funded these companies for even more growth. Essentially, a lot of these companies disappointed investors over their past few earnings calls in their profitability. Essentially, the valuations were just too high to justify the rate of growth in cash flow and profits for some of these top hydrogen, clean energy, and EV companies. And as we all know, there was an influx of cash in 2020, which just turned out to be unsustainable. And although, yes, in the short term, all of these factors are valid considerations for selling off some of your biggest renewable energy holdings. In the long term, for the next 10 years, this might not be as big of an issue for long-term investors. And the reason for that, folks, is very simple. Here I have a chart of the 10-year Treasury yield, which is a moniker for interest rates, alongside the clean energy ETF that I just showed you, which skyrocketed in 2021 and now has crashed back down to earth. And now that interest rates are levels we have not seen since 2009, it is potentially reasonable to expect that these levels are yet again unsustainable, and we're going to bounce back to the median that we saw of around 2 to 3% on the benchmark Fed funds rate. And the most important differentiator here is that right now, some of these companies, although not profitable, are investing in a lot of manufacturing capacity, particularly in the US. And what this means is that not only will costs come down much faster for these companies, but the valuations that are now potentially overstretched to the downside will also become unsustainable, and there could be a growth opportunity for external investment, particularly as there are more tax credits and legislation for incentivizing new projects, which are already starting to gain some traction, as seen by the biggest hydrogen energy storage project funded by the government in Utah, as well as the first offshore wind farm off the coast of Vineyard. As demand spiked during the pandemic, capacity production was not able to keep up with the demand. This led to price increases for some of our favorite clean energy companies, and as inflation skyrocketed, the cost of making even went up higher. And that is exactly what has squeezed the margins and profitabilities of clean energy stocks, the higher costs of borrowing, which are potentially creating a dark cloud over their growth. But as I just mentioned, all three of these factors contributing to these losses are short-term only, unless there is some black swan event like the pandemic that completely halts growth in the economy. And this, folks, is why I continue to buy the dip in clean energy stocks, which I personally know are extremely heavy in my portfolio. These companies include solar players like Enphase, which have been beaten down significantly over the past 2 months, as we have seen this rising interest rate affect the growth of this company. And we also have stocks like Bloom Energy that are nearing profitability and one of the big market share leaders in the hydrogen fuel cell sector. As these companies approach cash flow positive, it's going to be much easier for these companies to raise money and take on the massive market opportunity that lies ahead of it, similar to what Tesla did throughout 2019 and 2020. And then there's also stocks like STEM in my portfolio that are more focused on battery energy storage, and although our early stage companies are still trading at relatively attractive valuations compared to where their growth can take them if everything is executed properly. And then finally, we also have EV players that I'm still investing cautiously in right now because of the massive market opportunity, as well as limited competition in something like the hydrogen trucking space right now in the US. As usual, folks, nothing is really guaranteed in the stock market, so prices could continue to fall. But the reality is that as an investor, it's important to be a contrarian and use your critical thinking and experience before really making any sort of short-term decision. And right now for me, the solar, clean energy, and electric vehicle opportunity is still good enough to warrant an investment given even the macroeconomic headwinds we face in the short term. As usual, folks, thank you very much for watching. Let me know your thoughts down in the comment section below, and I'll catch you guys in the next one. Take care.